This is an episode with Sam from Arweave and also this new thing called AO the computer. I had a million questions to ask Sam to just kind of break down what AO the computer is, what is the hyperparallel computer, what is the permaweb, what does this mean for decentralized AI, decentralized AI agents, decentralized social. All of this and more is going to be covered in the episode, so stick around, give us a thumbs up, like, subscribe, and yeah, enjoy the show. So Sam, how's it going? Thanks so much for
It's
joining
going
us on
well.
the podcast. It's been a long time coming. As I was mentioning off air, I got sick, but we've been following our weave since as long as I've been in the industry. And as I say, with what we want to get into today with AO, we're just super excited with what you guys are building. So there's going to be a lot of selfish questions because I'm really interested personally, and then I will get to some questions that I can imagine the audience are wanting to know as well. So yeah, thanks again.
Okay, awesome. Yeah, thanks for having me on.
Anytime. So, can you bring us up to speed with where you guys are at with Arweave, and then at what stage of the development was like, yeah, we need to push into what you guys are building with AO, because there's a lot of moving parts, and I want to kind of cover that, set the scene, and then dig into the meat and bones of it.
Yeah, for sure. So, Arweave is a permanent information storage system. Uh, Put simply, it's on-chain storage at arbitrary scale with a sensible economic model to make that work. So, essentially, a storage endowment. Because the problem, of course, is that if you have an ever-growing ledger, which like all blockchains are, you need some way to pay for it if it's going to store very large amounts of data. Other networks get away with this by just not storing much. So Arweave is trying to fill that niche of, well, let's make on-chain storage scale to arbitrary sizes, like large enough that you can fit the entire web inside of it. And we got started in 2017 building this, and we launched the network in 2018, the first version. And at that time, we saw Arweave as just an archive of knowledge and history. Basically, it shared cultural space that was held in neutral trust without the requirement for any single third party to be responsible for it, such that we could basically see the past clearly when we're in the future. And as a consequence, make better decisions, essentially so that victors couldn't write history anymore. That was where we started. But along the way, we realized at the beginning this was going to be a very, very, very long adoption journey. Like building a permanent archive is not a couple of year thing. It's like a multi-decade process. Yeah, after probably about 6 months or so, we realized that because we built of mainnet, that is, because we built a mechanism that would allow you to store web pages, because newspaper articles like shared history came in the form of web pages, right? Like, because we built this mechanism of storing would you say web content? I think is a reasonable way to say it. And delivering that to browsers, which is just the natural way to browse this type of archive. We'd essentially created a sort of parallel permanent web to go along with the normal one. And through that process, we realized that actually there are a bunch of things about permanent information storage that are useful in the present, not just the distant future. But it's really not like, it's not obvious when you start on that journey what those things are. And to put it simply, it's essentially the idea of putting information outside the control of any third party or group, like neutrally held information. And so the first, prospect we identified in the short term with that we thought would be interesting is the idea of perma-web applications. So building open source, decentralized web applications that live on top of the system, that serve to people's browsers, just like the content in the archive. Except they have the properties of blockchain. They look like normal web applications, but they have blockchain properties, like they are immutable after they're launched. And you don't have to trust the person that launched it to manage it for you. What you see is what you get forever, essentially. And so we dug in that direction for 3 or 4, 5 years until we realized, and I guess it was about 3 years before we first had this observation, that basically computation, decentralized computation, is really just decentralized storage of information permanently. And the reason for that is, when you think about it, when a machine joins the Ethereum network or joins Bitcoin, actually or Solana, it really doesn't matter. What they do when they join is they download data and then they validate it. And so blockchains can be thought of as essentially just two fundamental components. There's shared data in an open data lake, and then validation rules on top of that are application specific typically. And once we sort of started thinking about it in that way, we realized, so if you have arbitrarily scalable storage of information, and computation is just, or decentralized verifiable computation at least, is just a deterministic virtual machine with a log of inputs and the program itself. Once you have these things, you essentially have the building blocks of computation. Once we realized that, well, we started using Arweave for smart contracts. And that's where things got really very interesting, I think. We were pursuing this approach called lazy evaluation, essentially. That's the closest parallel to this idea in normal computer science. Back in 2020, midsummer 2020. And the only other group at the time that had an interest in it was Celestia, but they were called Lazy Ledger back then, interestingly. And now it seems to be like the dominant, way of doing things. And so, there are 3 or 4, maybe more, but certainly 3 main ones that I can think of. Smart contract systems that are built on top of Arweave now, using this fundamental paradigm of, well, you use Arweave's permanent information storage at scale to store logs of computation. And then in the case of AO, which is the machine that we built starting about a year ago now, and is going to mainnet in February, we made it so that you can have any number of parallel processes. So we cut up the computation that you would normally expect inside a blockchain into basically arbitrary size chunks. And then we have those chunks of computation, which we refer to as a process. You can think of it like a smart contract. Instead of sharing memory, they pass messages between each other. And Arweave works as this giant message bus, basically like a messaging layer, a decentralized peer-to-peer messaging layer. And when you do that, well, you can have any number of processes running in parallel, coordinating with each other. And it starts to look very much like the scaling properties of a Web 2 system, not a traditional blockchain, which is really powerful. So maybe, that's like 10% of the journey, but it was already pretty rambling. So
no, that was great. That was a really, really great set the scene. You guys have had this very unique, and I think you guys are one of the only people to really do it and pull it off really well, is your kind of educational kind of piece to camera videos, extremely high production. And you did exactly what I said at the top of the show. I think there was like a very, very hook heavy line in one of the first ones you rolled out with AO, stating something to the effect of Ethereum being 5 times less powerful on a compute level than a classroom calculator. Like, forgive me if that the phrase and the terminology is wrong. And then I was like, right, I'm watching this 45-minute video. So,
nice. Okay, cool.
So can you expand on that kind of like analogy? Is that kind of the correct terminology of what I've kind of paraphrased there? And what are the current bottlenecks with regards to these kind of existing execution environments that people are probably using on a daily basis if they listen to this?
Yeah. So you're absolutely right. That phrasing was good. It's a single calculator that you would, get in a classroom, like a TI-83, I think was the example we used, has about 5 times the computational power of the Ethereum network, no matter how many nodes and how much money you throw at its security, which is really it's like an IBM mainframe basically, but distributed. Okay, so the fundamental problem that is holding back the smart contract ecosystem, as we see it, is the dependence on global shared state. Essentially, the idea is that and this, I think, as far as I can tell, just it wasn't planned. Like in Ethereum v1, they made a virtual machine where all of the smart contracts had access to the memory of all of the other smart contracts. This is what we call in computer science global shared state. And it's a horrendous way to make something unscalable. There's just no way to scale a system like that. And if you are building a distributed network or a distributed system in computer science, like a normal Web 2 one, then it's absolutely not the way you would go. You would engineer it around message passing, which is in fact actually exactly what this conversation we're having right now is based on. Like your computer and my computer and the server that's in the middle are all just sending messages between each other. Like the global financial system does not work by having this giant shared memory space, like one giant stick of RAM for the entire world. It's kind of absurd. Like it's just not going to work. But I think that what happened is that the EVM had this structure to begin with, and that was like a good V1. We're really not trying to bash Ethereum. Like what they did was quite incredible. And it took things forward a substantial way. And they only really fell victim to the success of the protocol itself, right? Like the thing that happens with protocols is that they become calcified over time. And that's actually what you want. You want it to be that no one can really change it, because that is what gives the users the rights that are the whole point of having Web3 in the first place. And if we don't have those rights guaranteed to users, if someone can just come along and like update the code base and have it adopted by everyone, then you're basically just using a product, not a protocol. So you want that calcification, but the problem is you need the calcification to happen at a time where the thing is sufficiently scalable. And for Ethereum, they calcified around the MVP. And they had this structure for sharding. I feel so bad watching the story play out. It's like it's a cringe-inducing in a way. It's like, but it is, because like they said, the solution is sharding. Okay, fair enough. In about 2017, I remember watching Vitalik on stage at some TechCrunch conference, saying, "Yeah, we're going to have like like 30,000 transactions per second by 2018, 2019." And the plan there was sharding. And then they tried to push in that direction, but there were so many stakeholders that needed global shared state that had sort of built their systems around it. So they would have to re-engineer things, that they moved away from it and they said, okay, we'll try and take another route. And then what they ended up with was like very bad sharding, which is
non-composable, no interop,
and predatory, right?
Yeah.
Like imagine, you've got that calculator, and we're like, okay, guys, calculators were a good idea. Let's maybe make it slightly more powerful though than one thread, for the whole world. And then you're like, okay, but different companies, which are essentially what most of these roll-up systems are, different companies are going to come and run the different threads. But it's inevitable that they're going to start to like compete with each other. Like they don't want their service to be commodified, right? If their service is commodified, then they don't have a moat, and people will just move between the different shards seamlessly, and their value won't accrue to whatever it is that their business model is structured around. Like if it's base, it's basically equity and others tokens. But yeah, and now you see Vitalik saying, well, maybe actually global shared memory we don't need it, turns out, guys, and maybe that whole sharding thing wasn't such a bad idea. It's just like, yeah, it really wasn't.
Not too late.
And so anyway, that's kind of where I see us at.
Yeah, I agree of all the above. I've been quite vocal on this, so I won't bore the listeners to death on any of my kind of regurgitated pre-rambling. But so can you, I don't know if this is possible, you're probably the best person to do it. Can you kind of give us a high level of what AO and AO the computer actually is? And then I want to kind of pick the bones out of it, because there's a lot of moving parts. And I think I truly understand it, but until I start asking these questions, I'm going to have a lot of revelations.
Okay, sure. So there's the very simple answer, which is a global decentralized supercomputer. But I know everyone in crypto has heard this so much now that we don't generally lead with that, because this industry is like the industry that cried scalability, and it's like never true. But it actually is in this case. So let's jump into that. Like how does it achieve being a decentralized supercomputer? Well, essentially what we do is we break down the traditional elements of a blockchain system which are sequencing, so consensus on sequencing of information, and computation, so attestations in one form or another about the correctness of some output from something that is sequenced. And then we add a third component, which is messaging. And we basically say, okay, everyone in the system can make any number of processes they want. There's no limit on this, and there's no what would you say, specified resources by default. Like it's just basically a data protocol, a way of outlining, hey, I'm a process that does this or that, and moving those things around and then writing them to Arweave. Then we allow users and developers to choose the security properties that they want for their processes and keep that composable. Because this is a fundamental thing, like as you pointed out, with the Ethereum landscape, you've got all these different rollups, and they're really just not incentivized to cooperate with each other that much. I mean, they're perhaps incentivized to be polite in public about it, but like they're not actually over a 10-year time span. They're not actually, incentivized to work together. So we cut off that problem by basically saying, okay, everything inside the system is commodified at the infrastructure level. So it's very, very easy to purchase essentially the service of having a process scheduled. That is an open network of scheduling systems or nodes that will take the work and then do it for you. And then you can also move between them to other nodes at will. And that's all commodified and thus decentralized. And what do you say, incentivized to work together rather than specialize, which is what happens in these systems where like you have companies running individual services that are depended upon by different parts of the infrastructure stack. So we have scheduling as, this decentralized scheduling network. And similarly in computation, we do the same thing. We commodify the compute market by basically allowing anyone to plug in a machine and say, hey, I'm willing to run, WebAssembly containers up to 8 gigabytes of RAM or 16 gigabytes of RAM doing this much computation per step, and I'll charge you this much for it. And also I have this much stake available, and you have to pay me this much to get access to that much stake for this period of time. It's a lot of different parameters, but fortunately the user doesn't have to care. They just throw it to the network, which will resolve it for them to find you a compute node to execute your process, to basically resolve the state of the interaction. And then we have these messaging units, which are just kind of orchestrating these two other components of the system. So how the user actually uses the system is they go to a messaging unit and they say, hey, please like push this message around the network for me. And perhaps I'm transferring you a token or something. And so I send a message to the token process, and I do so by signing it, giving it to the messaging unit. The messaging unit gives it to the appropriate scheduler, the person that is assigned as the scheduler for that point in time for that process. And then they ask a compute unit of their choice, hey, what was the outcome of this interaction? And if there are further messages, then it essentially just continues pushing them in parallel. And so what you end up with here is, call it a hyperparallel computer. Basically, you put one message in the start, but perhaps you have a handler set up on your process such that when I transfer a token to you, you actually go and buy something on an exchange or something like this. And so then another message is a result of my first message, and that gets pushed around the system. And then, I don't know, maybe when you buy something on the exchange, you actually trigger someone else's autonomous agent, which is portfolio rebalancing, and they're going to go and buy and sell something else, and so on and so forth down the line. And so you take like a global shared data layer and you turn it into an active compute environment, essentially. And you do so by just chopping things up into the smallest possible unit of parallel computation. So a single process can interact with the rest of the world, but it doesn't have shared state. It just sends the information that it needs to other parts of the system.
Yeah, so along with like kind of the pitfalls of what we've previously spoke about with our shortcomings with modularity, and you best buy into my SDK or you're not getting interop across specific ecosystem. I don't need to know many names there, but people probably read between the lines. The other kind of extremely heavy buzzword here, which you guys have, and I want to kind of pick your brain on how other people are positioning compared to you guys, is like parallelization. And obviously we've had kind of sequential ordering transactions through Ethereum and like different EVM L2s and different sovereign EVM compatible chains and things like that. And then Solana is kind of pushing this, I believe it's like 4-thread model where it relies on the account or smart contract deployer to specify which part of the state they want to interact with, and then it causes, you don't have this noisy neighbor problem, but it kind of happens. It's happening now as we're recording this with Grass. Grass has just launched their token there, and it's happening. So we're still not there.
Yeah.
And then you've got like the likes of your Monad that are pushing to go beyond like 4-thread, and like what is actually happening with regards to parallelization? Are people throwing it into DEX to raise a lot more money? And like, what's the AO kind of stance on parallelization?
Yeah, right. No, that's an interesting one. And this speaks to the crux. So we call it a hyperparallel computer, not because it's like marketing. What do you say?
It is great marketing as well, but
well, I mean, to be honest, I'm like a tech person. I don't particularly like the marketing phrases. And it actually speaks to a problem, which is we're trying to come up with like, yeah, we see everyone else's, okay, so everyone learned pretty quickly, like if you're on the tech side of the industry, single thread of execution shared between everyone in the world is probably not a good idea, which is not rocket science. Yeah. And then there are these models, exactly like you described, that have some local locking of memory. Like Solana, and Monad is the same, it's just slightly more threads. And that is parallel in some form, although there's some nuance there because it always has to come towards a point, right? A single block that is being produced in the system, and that part is necessarily not parallel. But you could argue that's like MapReduce. But anyway, it's partially parallel. That is true. But the way that AO is structured is like pretty radically different. It just says everything runs in parallel. Every single smart contract. Every single smart contract is essentially a different blockchain, but without the bootstrap requirements of app chains, right? Like there's Cosmos, Polkadot. They had some of the right ideas, which is, well, maybe we should just let each application have their own block space. Yeah, that's kind of wise. What's not wise is getting each individual project to have to bootstrap their own security. You want the shared security system of Ethereum or Solana, but with the, what would you say, like private block space, almost, or like non-shared, but not in a bad way, block space that you get with a system like Cosmos or Polkadot. And so basically what we do is we have a generic set of scheduling units. So they're shared between every single application, and anyone can come along with a new process at any time and just throw it to this set, and they will get a good price for the sequencing of their computation. Or even if they want to, actually, they can use like Arweave base layer for data availability with a more traditional blockchain style consensus mechanism with proof of work on the sequencing, the ordering. But they can also use something that's like an Ethereum rollup if they so desire. They just basically ask the market or tell the market what requirements they have, and then they get back a match with a service provider that's willing to do it. But that service provider is commoditized, so they can swap out that service for anything else under the hood as the market shifts over time. So we see it as this different approach to the construction, basically, of the virtual machines, right? Like you have this different sequencing layer underneath, which works extremely well for separating out the computation that's happening in the computer into many different parallel parts. And then on top of that, you have to just structure the virtual machine in a way that doesn't, like, would you say, depend upon the notion of shared memory and a lot of synchronization of state. And the way that you do this is like classic computer science distributed systems question. You just throw messages around the system rather than expecting that two people are going to be in contention to use the same bytes. So when I make that transfer to you, I send a message to the process that says, hey, this other process, want to send messages over here. And want to send tokens over here. And the process receives this, and it doesn't need to know anything else about my state or your state. It just changes its own private memory with basically its own subledger, if you will. It says, okay, cool, now Grant owns the tokens. And then it'll send you a message saying, by the way, you've received some tokens, and it'll send me a message saying you've sent some tokens. and we can process that as we like. And everything is sort of event driven rather than being based on the notion of having like one shared ledger between everyone. It's actually more like we all have our own sort of representation of what the world looks like, or the parts of the world that we care about in order to do our jobs. And then we orchestrate together by just dispatching messages around.
Yeah, that's a really interesting point, actually. There's another kind of thing that I'd love your take on, which obviously I'm as left curve as you get here. I'm not technical whatsoever. I'm definitely more a market participant, investor, and just general enthusiast in the space. But what I'm seeing from a lot of application developers and founders at the minute is quite a lot of confusion of one, where to deploy, two, if I do deploy the like let's say I deploy my application on an L2, like a general purpose L2. Why should I do that? Like if I'm going to be one of the main causes for demand for block space on that L2, where's my kind of kickback to the sequence of fees? And then, or shall I just go app chain and then lose all composability? Like there's so much confusion for developers at the minute. Like where's the AO, I suppose, pitch for these kind of people that are at a little bit of a loose end? Because I'm hearing it every week now, and it's starting to get kind of like a real desperate for a lot of developers that are building out there.
Okay, so I guess our take is essentially scarcity of block space is an atrocious business model. It is a catastrophically bad idea. And this should be self-evident to anyone for two reasons. Okay, the first is that, look, what does scarcity of block space mean? Right? It means that there are more people that want to use your application than can use your application. Okay, in what area of life do you have like a hyper-growth business where everyone has to queue and they can't use the system? Only a very, very select few, like 1,000th of the people that want to use it, can use the system at any point in time. Like it's just not. It's not a way to certainly build web application services, which are what almost all these things are. And then on the other side, using block space scarcity to subsidize security is a really dangerous idea, because consider like a thought experiment. Let's say that Ethereum tomorrow magically scaled infinitely, right? And it was still a single thread. Everyone's using the same blockchain, but it just scales now. And we don't have a block reward anymore because time has elapsed, and the Ethereum block reward ebbs away to zero essentially over time, or zero proportionately to the amount of tokens that already exist over time. So we're in this situation. How much security do we get? The answer is like virtually none. We get minimal security, like literally in the sense of, I think it goes down to one GUI, per interaction, because you no longer have scarcity, right? And so you get this really counterintuitive pattern that basically the more scalable the system is, which means the better it can cater to its users. And downstream of that, the better its network effects will be, by the way. The worse the security is. Like you can't buy more security either. So if the system is just subsidizing a tiny, tiny amount of security, then that's what you get. And that's just how secure the system is. Like that's not going to work. there's no way in which that is viable. And you kind of see this playing out a little bit with Solana, which is, as we described before, it's like, you said 4 threads. I think it might be 12 or 16 possibly, but okay. I could be wrong on that, or 8, and it's somewhere below 16 as my memory says. And for contrast, like AO has 110,000 active processes on the testnet.
Just a little bit bigger.
Right. Anyway, you see this situation where Solana is more scalable, right? And so the demand for block space is lower. And because demand for block space is lower, the only way to keep it secure is to have essentially large subsidies. But what are those block rewards, those subsidies? Well, they're a tax on token holders, right? Like, if we mint 3-5% of the token supply each year just to basically keep the thing secure, then it's like you're faced with 5% inflation a year, just for the right to transfer your value around, which now when you compare that to like the fiat monetary system, it's actually not looking so good. So you have to build systems whereby they can scale properly, and also they have value accrual mechanisms that are, incentive compatible, right? So having a mechanism whereby, you're pushing away users will inevitably push them to your competitors. And like most of these services in cyberspace, they have some network effects of some sort. And Ethereum does experience network effects, particularly in the form of liquidity, right? So there's not a large number of users per se, but there's a large amount of value there, and that seems to have some network effects. But it's not going to scale to be like Twitter or something like this, because if it gets anywhere close to that prominent, it will just self-limit. And yes, okay, maybe that pushes up, block space fees for a while, but it won't work long term, because you're just pushing away the users that might want to use your system, and they'll go somewhere else, and it'll be over eventually. Like, these things are very, very slow, but yeah, it will happen. And so instead, what we do with Arweave first, and this wasn't like we planned it this way per se, but every time you use Arweave, or we didn't plan this as precisely an elegant value capture mechanism, it's just we were trying to solve the problem, and turns out that this was one of the properties of the system. Yeah, when you use Arweave, you pay for 200 years worth of storage upfront, present day prices of AR and storage, terabyte months essentially. When you do so, you take those tokens out of the supply and they sit in the endowment. And the interesting thing is, Arweave is essentially a risk model, like any endowment. Basically, we're saying, well, if we get this amount of generation of storage purchasing power per year, you could call it interest, but in the form of storage purchasing power, then the system is solvent, and it remains solvent arbitrarily long into the future. But it is a risk model. So Arweave says, well, okay, you pay for 200 years worth of storage at the present day, present times, present costs. That means that if the price of storage declines at a rate higher or equal to 0.5% per year on average, plus minus volatility of the token over time, then you end up with a system that is solvent for arbitrarily long periods in the future. But if we had chosen, say, 1% storage cost decline rate, and like the actually observed rate's around 38% approximately in the last 50 years. So it's very conservative. But you're trying to buy permanent storage, so it should be conservative, right? If we'd have chosen 1%, not 0.5%, it would be cheaper for users, but they would also increase their risk. And so it has this value accrual mechanism that is non-extractive of the users, right? They are buying something that they genuinely want. It just takes capital, or R, essentially out of the environment proportionate to usage of the system. And because of the way that Arweave scales writes to the network, which is basically a process by which we bundle data together. So we have many different people who want to write to the network. They essentially concatenate their data items, their transactions, into larger bundles, and they submit them all together in one go. Then you have one payment that is settled rather than 5,000 sometimes in these bundles. When you scale it like this, every usage of the system, each of those 5,000 inside a data bundle, is just taking tokens out of the supply and putting them aside for like an extremely, extremely long period of time. In fact, actually, with all the modeling we've done, in most cases, those tokens, most of them just don't ever leave the endowment again. AO, we had to take a different approach because it's a different type of system. But when we were looking at it, we saw very clearly that block space scarcity wasn't going to work because we don't have any block space scarcity. So how would you build a model based on that that is viable? And we saw instead that actually what you really want is, like, what does it mean when you're buying security in a blockchain network? You're trying to buy some sort of insurance, right? Like collateralized expectation of correctness. That's what a proof of stake network is essentially giving you anyway. And so we try to make that just explicit. So when you pass a message in the network, you can pay someone to basically assign stake to it for a period of time. And then if there is a fault with the message that they have claimed is from your process or to your process, then you can claim against that insurance. It's a pretty simple system that just takes tokens out of the supply proportionate to the usage of the network, the volume of interactions that move around it. And at the same time, it gives people the ability to have flexible security. So like my, half a cent microtransaction does not need the same security as $10,000 transaction moving around the system. Like this is also a part of the current, would you say, meta that just doesn't make any sense. And so, yeah, we make it so that you can make that customized. Basically, you pay the staker for access to their stake, and not just access to their stake, but like solo, like quarantined or fenced off, collateralized in the traditional sense, access to their stake for a period of time. So you can claim against it as the sole claimant if there was an event of fraud. Yeah, so we base the system around this, and it allows us to, let people buy the security that they actually want, that is sensible for the application that they're building, at the same time as avoiding this kind of quagmire of like, the more scalable you make it, the less secure it becomes, and subsequently, people actually aren't incentivized to make it scalable. It's all pretty odd, to be honest.
Yeah, it just seems like complete common sense. There's a few kind of building products towards that have kind of recognized that. And if you think about some proof of work systems that have drastically overpaid through emissions to kind of stay afloat, which then starts to begin to look like a bit of a security death spiral if you don't have the activity. And then I think, like, I was speaking to Brian Pellegrino about this, like, there's gaming applications or social applications that definitely don't need the same level of security as a money market, say, for example.
Right.
So there's a lot of people thinking about this problem, but it just seems as common sense. It shouldn't just be like a one size fits all blanket kind of this is what you pay and this is what you get kind of thing. And it just feels, I don't know, kind of prehistoric. That's how like the industry has kind of moved. And it's, can I ask about some of the applications that are getting built over there? I seen that there's like just a whole host, and I suppose like what's the date we're recording this? The 28th of October. So last week we've had this explosion in AI agents. So that's on the tip of everyone's tongue. Have you seen any teams that are building towards this in the kind of AO environment ecosystem? And is there anything interesting there that you can kind of push listeners and viewers towards?
Yeah, definitely. So this was something we realized pretty early with AO. So one of the things when you have this flexible security model, you have like an open pool of security that people can bid for stake from. One thing we realized pretty early with that is that it allows you to detach the traditional like re-execution requirements from the consensus stage of the blockchain, right? And you could look at every process in AO as if it is a blockchain at like the data structure layer, but not at the infrastructure layer. It's using shared different type of infrastructure, but each message is essentially a block in the blockchain, if you will, for a process. So when you have this type of model and you're just paying people for the security that you need, then you don't need that many people to execute it. You need random re-execution of interactions sometimes, but not every time. And that means that you can have far, far larger compute requirements than in a traditional blockchain environment, where essentially everyone needs to execute. And not just they need to execute, they need to execute in real time, because block production is essentially paused while everyone is validating, or at least the head of it, which is really, not great. So in the system, you can do more or less arbitrary amounts of computation. You have to have a bounded time limit for the execution. Has to be some finite number of steps. But if there is someone out there willing to basically stake against the execution and enough people that are willing to revalidate it stochastically, then you can do any amount of compute, just as long as you can put a time bound on it. And so this meant that you could do things like run LLMs inside smart contracts, just full large language models inside smart contracts, and then have people stake against essentially attest against the correctness of the results. and have other people revalidate it to challenge that. Yeah, and so we got Llama 3 working on top of AO in I think it was June, late May, June. Yeah, which was pretty wild. And so one of the first things we're trying to show to people what this means in practice. What kind of things can you do with on-chain agents? And the first thing that came to mind was a llama fiat simulator meme coin. Essentially, there is a llama, which is a Llama 3 model, of course, that you can go and you can try and convince to give you coins. And he lives inside this little world on AO. And you send him your bid and you say, I really think that hay is a great thing. I love llamas. I want to build a llama sanctuary, and they might give you some tokens.
That's great. That's great.
But we're trying to prove a point about autonomous monetary systems, right? Because essentially what DeFi did is it made the settlement layer of the economy decentralized and trustless. And that was extremely powerful. Like, full credit to Ethereum, they made that whole thing happen. It wasn't going to happen on Bitcoin, and it was truly, truly impressive. But the intelligence layer, right? The decision making that leads to interactions happening in the settlement layer. This was all completely off chain, right? It's people, their computers looking at the exchanges. It's people that run like crypto funds, and others can delegate capital to. It's all human in the loop. Well, when you have the ability to run arbitrary amounts of computation on chain, you can make autonomous agents be the loop themselves. And they have the same guarantees that you would expect from a normal blockchain application, which is really, really powerful. So you can do things like have, as I described before, someone's portfolio agent, right? They want to maintain an 80-20 split between some liquid, volatile asset and a non-volatile asset, something like this. And well, the agent can just live out there on the network for them, and it can adjust its distribution as needed as prices change over time. So it's sort of like a bot that lives working at the behest of the user while the user is offline. But it can get way deeper than that. Like, you can theoretically, you can just read the news, for example, and have a bot that is interacting based on that content. So because the whole thing is on Arweave, you can also read full web pages. Like, you can pull stuff from the centralized web, pull it into Arweave, and then read it into your smart contract and analyze it. And that would allow you to do things like, buy or sell things based on Wall Street Journal headlines, for example, or look at crypto Twitter if you can get past the bot protections on reading. But look at crypto Twitter, or maybe Nostra or Blue Sky or something. Farcaster, and see the signals that are being generated. Like, people are talking about this today and not talking about that. Well, I should buy and sell in this way. All of this can be done now in a trustless way. So in the same way that like DeFi summer, we had this wave of basically, anon people in their basements making financial services, which in any other industry would be completely absurd. In ours was only mostly absurd. The part that was not absurd was that those services are trustless, right? So if people as a community audit the smart contracts, they can trust the strategy that is being executed. And now that strategy is intelligence rather than just settlement. So if you're interested in this playing out on AO, I strongly suggest that you follow Autonomous Finance on X. They're really leading the way in the ecosystem. With regard to this, they're already building like trailing limit order book agents that will basically like watch the price changes over time and then execute these. What would you say? Like, I would say they're like medium intelligent processes. Like, they're not putting a large language model in the loop, because it turns out like most of the time you don't want to do that. Nor the larger statistical models, but I think that's where they will go next. But they're absolutely non-trivial. Like, these are not the types of things that you could do on, I think, any other chain, as far as I'm aware. And so they have some launches coming out, the initial launches of agents in the next week or two. So definitely make sure to follow them.
Yeah, it seems very timely and top of mind for the full industry. It just needs that kind of super catalyst for everyone to start paying attention to what's going on, and then everyone tries to find well, who's actually operating and executing on this the best. So if anyone's listening, I'll leave the links in the description. I need to go and check it out myself, but that's super interesting. The other aspect, which no one seems to have cracked for whatever reason, scalability is a huge aspect of it, but social.
Mm.
I think there's something there. I just don't know why we haven't got to it yet. And I think scalability and UX is a huge aspect of it. But I know for a fact there's a lot of teams building towards it and in the AO ecosystem. But if you can kind of like fill people in what the kind of lay of the land is over there on the social side, that'd be great.
Yeah, so I think Odyssey is definitely the furthest along in terms of real world adoption of decentralized social. They have about 7 or 8 million monthly active users, which is really pretty astonishing for like a crypto, if you will, project, Web3 system. Like it's almost as many monthly active users as Ethereum in totality, I think, or maybe even past that. I know the numbers are in the same ballpark anyway. Yeah, and Odyssey is essentially putting the whole system on AO and Arweave. They're moving directly to the permaweb. And I think you're exactly right that the scalability of the infrastructure has been the problem for a long time, as well as the user interface, right? Like how do you interact with these systems? And we're pretty excited in the Arweave ecosystem that we think we're like just crossing the chasm to the point that it would be relatively easy to bring a non-crypto person into the ecosystem and have them get started with the applications, but also get the full benefit of it. Right? Because the problem that we've seen throughout the history of Web3, I would say, like let's say the post-Ethereum era in crypto, is that as people have attempted to build applications that were better user experience, like easier to get on board with, they've started to cut away and chip away the things that made crypto worth using in the first place. Like there's this, I'm not sure if you're aware of the like mythological symbolism of the like dragon eating its tail,
The
the
Ouroboros.
Ouroboros. Yeah.
Yeah.
Well, it's basically that. It's like I don't know how many times I've spoken to a team where they've told me, hey, we're building decentralized X. It's like, okay, that sounds good. You hear a little bit about it and you say, so is it actually decentralized then? And because they're just giving you a .com link, right? And they say no. You're like, okay, so what you have is just X, or whatever that X was, but no one uses it. It's just a bad version. So that's not going to work. So you have to make it so that the user experience is sufficiently simple while maintaining the properties that actually made the systems exciting in the first place. And yeah, that I think the reason no one has done it, well, two reasons. One, to be frank, is that blockchain is an unbelievably distracted industry. Like if we just all agreed that crypto Twitter, we weren't going to go on it for like 3 days a week or something, I think this industry would get like 50% further faster easily. Yeah, so there's a lot of like focus and attention around the very short term, and it makes building very, very long-term things less appealing to people, I think, and it disincentivizes it basically. There's a very, very heavy incentive shift towards the short term. The other problem is that like to build a properly decentralized social media ecosystem that is actually viable, where each of the components actually makes sense, is not a minimal viable product. It's a minimum viable ecosystem. And it has at least, as far as we can count, like 8 or 9 different components that are the size of a normal product. It's not the kind of thing you can hatch overnight. But yeah, the Arweave ecosystem has been working on this for like 6.5 years now. And we're just getting to the point where we can practically serve a Web 2-ish audience, an audience that came for the properties of blockchain, but without being that interested in the crypto-focused elements of it. At scale while maintaining the rights that like they should have when they use a blockchain system.
It's great having the systems to be able to accommodate a Web 2 size audience. What is a few points on the DevX experience for builders and a UX perspective, as the industry seemingly pushing towards a little bit more of account and chain abstraction and getting I suppose crypto rails are definitely at the back as opposed to what's previously came. They've been front and center. Everyone's just confused as why they need like gas tokens and what is this thing, and I have to buy tokens to actually use the whole thing. Like, how are you guys positioned in that from like a developer experience perspective, and how easy it is for them to build in the ecosystem, and then how seamless can it be for like a drastic amount of users to actually onboard and not have ridiculous amounts of friction, which we see across the full industry?
Yeah. So I can't speak for the whole ecosystem because it is truly
Yeah,
decentralized. Like Arweave and AO are the things that we forward research have been most involved with building, but there's a ton of different stuff across the stack. Yeah, the way that we see it is, it's funny, we would never have called it chain abstraction or account abstraction, but I guess that's what it was. But we started like 4 years ago now, not 3 years ago, creating systems of bundlers. So when you upload data to Arweave, basically someone else settles the payment for you, typically, along with you and like 5,000 other people, or 10,000, doesn't, those bundles can be arbitrary size. Yeah, and there's one payment that goes to the network, and then users pay the system, the service that is bundling for them. And at the moment, those are basically off-chain payments. And so that's one of the things you lose, at least in like pure Arweave implementation of it. You don't get, like, they could theoretically run away with your $5, but like, it's $5. Like, you don't need blockchain levels of security for $5. It's just not, it's not reasonable. And it's a very reasonable, would you say, sacrifice to make for arbitrary scalability, which is what you get on the other side. But that opens an interesting avenue, which is that basically the user is signing with their keys. And those keys, because they're not, Arweave uses RSA under the hood, like the base layer transactions. But these bundled data items are not base layer transactions. So we don't need, again, from the protocol's perspective this time, the same level of security. So you can use whatever keys you want. Like, it's just bytes as far as the network is concerned. You interpret those bytes at the user level as, Grant has uploaded this piece of data, which is his tweet that says this. And so it's up to you then what kind of security you want to employ. The network doesn't care because it's just happy storing your bytes for you. And then on the back end, we use extremely heavy encryption to secure the real payments and settlement in the network. So you can use your own key types, which means that you can store with Bitcoin keys, Ethereum keys, Solana keys, and Arweave keys, and I think a few others on top of that, like really all the main key types. And then you can pay and basically top up with your bundling account using whatever the bundler wants you to. And so sometimes that can be fiat payments. You can top up with Stripe. Like, you want to upload some data on our drive. You are fully self-sovereign. You own your identity, and you can upload or you can top up with your credit card to their bundling service, and then distribute your data entries, data items to them, and they will bundle it and send it to the network on your behalf. Or you can also top up with Solana or with Ethereum or with Matic tokens. It's really like arbitrary and at the user's discretion. And then on the AO side, we think that we will attempt to adopt a similar strategy as much as possible. We really think that like token economies should just be viable without having to force your users to have the tokens where actually they just want to use the system, right? If your token economic system is not viable in that environment, there's probably something else wrong with it. Because you can't go around trying to force all the Web2 people to go and buy your volatile token in order to use your service. It's not really going to work. Like, we need to be thinking about how can we onboard like 500 million people in 5-10 years. We're not going to do that if we have to introduce them to the idea of volatile token prices and also KYCing with an exchange and also 10 other things down the line. If you can make it so that people can basically pay with debit cards and credit cards, or if they have some crypto tokens, great, take them from wherever they have them. And then you have a token model that actually accrues value proportionate to the usage that they generate anyway. So without the users having to be the ones that have direct exposure to it, then I think you're on like an incentive compatible and sort of adoption compatible track. And that's what we're shooting for.
Awesome. Love to hear it. Well, Sam, thanks so much for dropping by, and we're going to be covering you guys from the research side, so that should be coming out for anyone listening. If it's out in time for us publishing, I'll leave it in the links below. Anything we spoke about will be below. For the 50% of people who listen regularly and don't subscribe, that's not great. Please subscribe. And yeah, Sam, thanks very much, and we'll see you next time.
Thanks so much for having me on.
Very welcome. See ya. Bye.
Quick one, nothing here is financial advice. It's for entertainment and educational purposes only. Always do your own research or speak to a financial advisor before making any investment decisions.